This week we're reviewing the SATRIX Dividend-Plus Fund, an exchange-traded fund compiled by SATRIX. It's been around since August 2007 with a fund size of R1.5 billion and a total expense ratio of 0.45%. Cobie has more details on that.
Yeah, I mean, look, firstly, I think, again, we're looking at something here for a self-do investor. So we're looking at an exchange-traded fund that mimics the movement of the FTSE JSE Dividend Plus Index. So remember that all the ETFs have to mimic the movement of either an index or a commodity or something. We're looking at that. Again, the total expense ratio here is 0.45%, which really isn't a huge price to pay in order to try and get, let's say, an active component into your total return, but by utilizing an ETF. Let's just quickly look at some of the returns that have been created by the SATRIX Divi Fund. And if you have a look there, there's 1 year, 2 year, and 3 year returns. So obviously 2 year and 3 year returns are per annum returns relative to the Divi Plus Index. And obviously there's some underperformance here. And the reason quite simply for that is because obviously there's a fee that needs to be taken into consideration over here. So that obviously makes a difference. Just to show you, and I mean this is a chart that we always show you, is its relative return relative to the benchmark. And you can see how it actually hugs the benchmark. Each of those bars indicate the by how much it actually under or outperforms the actual index. And then to see what the index has actually done over time, you can actually look at the rolling returns there as far as the index is concerned. I mean, and for a do-it-yourself investor, you want to own equities. This is not a bad space to kind of to start understanding equities.
It's not a bad space, but be aware of what you've got. You haven't got the all share. You've got a segment of the all share, which are shares that have a high dividend yield. So good news, you get 4 to 5% dividend yield out of it. The bad news is it's got about a 9% tracking error to the actual all share, and it has very low exposure to resources. So if we get this boomerang of resources coming around, you're not going to be in on that.
Yep.
It's doing spectacularly well now because it's got a very high exposure to the consumer service companies and a few of the other companies, Coronation, companies like that. So it will perform well now relative to the all share. But it will be very variable.
And as a principle, often it's touted a dividend payment or a company's ability or track record in paying dividends is often touted as a selection criterion for stock picking.
Yeah.
Where do you stand on that?
Here's what I like is confidence in dividend growth. This doesn't capture this. This captures a forecasted dividend yield. And so you are dependent upon, some of the international indices do dividend growth, but we don't have a strong enough history in this country of sustainable dividends to be able to do an index like that. Would you agree?
Yeah, no, I agree with that. You see, I mean, if you look at the JSE, I think firstly, it's a very disparate index. Okay, so you've got resources that are kind of the mainstay industry in South Africa with financials and industrials. Interesting at the moment, you've got resources doing quite poorly at fairly depressed dividend yield numbers, but at very attractive price to earnings ratios. And then you've got the rest, and this is basically what Anne said just now, financials and industrials that have kind of gone the other way and are literally keeping the JSE all share buoyant at the levels that we've got at the moment. And those are sometimes, and in certain cases, all very attractive dividend yields. So the active stock picker would obviously look at this and try and understand what the best way of doing so is, and would obviously charge an active fee. In this case, there's a passive fee that gets charged, and it asks and says, over time, if you capture a dividend yield effect, how can you capture decent returns by doing so? And certainly, historically, it has done so. The question is, will it always be like this, for the next 12 months or 24 months or so? Just look at the table that we've got for you. That's on screen at the moment, and it'll show you the top 10 holdings. And this is now obviously at the end of June. And then you can see Kumba Iron Ore obviously in there, decent dividend yield, and there you go, financials, and you can just kind of have a look right down there, and said that just now, financials, industrials, all in the kind of equation over there. Remember, rebalancing here on a quarterly basis. So again, if you're going to be an investor, and help me out here, if you're an investor, well, how does this relate to your objective? Really good returns, but don't buy it for returns. Buy it because it's appropriate to your actual objective.
And you get a yield out of it, a nice yield.
Absolutely.
And that's a nice little, and there's another thing to buy it for long term. This is not a short term punt, this index, because it really takes a while to kind of benefit from this.
And I mean, and you would agree, I mean, in a diversified portfolio, if you've owned this as an equity block, you're going to have to go and find ways that you can own bonds or property and cash and various other asset classes. And then you're going to have to think about how you asset allocate between these. If it's going to be strategic, is it going to be tactical?
And
how are you going to be doing it?
Are you implying that this could be a proxy for some of those other asset classes?
No, absolutely not. I think this could be an equity block if you understand the risks and the returns that could potentially come from something like this. This could be the equity block, but you'd have to think about ways how you could potentially add some of the other asset classes as well. And there are various ways that one could, be, for instance, be doing so.
The good news is probably less volatile than the all share because you have that lower resource exposure.
Yeah, and like you said quite appropriately just now, you're getting dividend yield for this. So you're actually getting something back in your pocket as an investor by just owning these. The question is, are you happy with the fact that the Aussie might do fundamentally better in the next 12 or 24 months because resources are coming back and this is not going to do as well as that? And are you still happy that's going to be in line with the actual objectives you're going to have?
Because what I heard from Anne's critique a bit earlier, that it's almost quite a mechanistic way of selecting stocks on the forecast of what their dividend yields are going to look like and not necessarily just fundamentally how the sector is going to perform and how individual stocks are going to perform.
Well, that's what's so powerful about some of these new ETFs that are coming out that focus on what they call smart beta or smart market segments. They say, if you want to pick a value manager, there's an ETF out there that'll capture just that aspect of that manager. Here's one that just captures good high dividend yield managers, and they're a class in themselves and very appropriate to a long-term strategy. Also to people who are going to retire and need to live off a living annuity.
And can I just finally ask you, if you had to compare or choose between an ETF with various characteristics and a fund, a unit trust fund, what are the important aspects of choosing between those? So, for instance, unit trust fund that's a high dividend payer. As opposed
Are we
to
talking
this.
about within one asset class? Because your biggest problem is what Cobie described.
Yes.
Who's
Let's say you had
do
to
the
choose
asset
between the
allocation?
SATRIX Divi-Plus and a high Divi paying unit trust fund.
Cost. Easy. No brainer.
Yeah.
Yeah, I mean, I'd like to add to that by saying, I always say to the investor, what is it that you're going to feel comfortable with? If you're happy to pay 45 basis points, which is really reasonable for an ETF, and you're happy not to have, just to own the asset class, fantastic. If you actually philosophically believe in what an asset manager is doing, then maybe it's worthwhile paying the active cost. It's down to the investor at the end of the day.